So as you can see, the discounted payback problem that we worked out here in the slides, just like normal. We can evaluate this rule using the same 4 criteria that we did before. Does the discounted payback rule account for the time value of money? Yes, of course. We use the present value of the cash flows to calculate the payback instead of the future value of the cash flows. Does the discounted payback rule account for the risk of the cash flows? Again, yes. We evaluate the risk and assign a required rate of return for that risk, and then we use that required rate of return as the discount rate to take the present values. Does the discounted payback rule provide an indication about the increase in value? And directly, the answer is no. We don't get any indication of value from payback. It simply says, how long does it take for the present value of the cash flows to equal the cost? However, as you saw in the example we worked, occasionally, if you do it right, the discounted payback rule is effectively the same steps as the net present value rule, because we take the present values of the cash flows and we add them all together and subtract the cost. So if you take all of the cash flows out from the cost and add them all together, then you do end up with an indication of value because you end up with the net present value. But then, should we consider the discounted payback rule as our primary rule? And the answer is no. It sort of fails at both things instead of doing one thing well, right? It's not as easy and it's not as simple as using the regular payback rule. And if we're going to do all the assumptions and make all the assumptions and do all the hard work that we would require to get the net present value, we might as well just do the net present value. It's the better rule anyway. Payback or discounted payback still has this arbitrary limit. So it sort of falls flat. It's a case of economists sort of failing to see the forest for the trees. The next rule we're going to talk about is called the average accounting return rule. And while there are many different definitions for average accounting return, the one that we're going to use is average net income divided by average book value. And what you have to remember is that what's really important here is that what we're talking about is at the project level or the investment level. So average net income is the average net income generated by the project or the investment that we're interested in. And likewise, average book value is the average book value only of the project level assets, not of the entire firm's level assets. But as you might remember from our chapter on ratios in chapter 3, this should look just like the project level analog to the return on assets for the firm. So return on assets is firm net income divided by total book value of the firm's assets. This is just project net income and project book value. So this does have some economic and accounting intuition behind it. And that's what will give us the rule itself. This intuition will give us the rule. So the rule is we take the project if the average accounting return provided by the project is greater than some target cutoff rate. And again, this is arbitrary in the sense that we have to choose the rate. But for most established firms, the rate they're going to use in an average accounting return is the firm level ROA. Because what they're interested in is, does this project contribute or detract from my firm level return on assets, which is a measure that investors care a lot about. So we'll say, if the project provides a benefit to my ROA, firm level ROA, because the project ROA is higher than the firm's ROA, that'll bring up the firm's ROA. If the project's ROA is lower than the firm's ROA, that'll reduce it. That's not something managers are interested in. So we'll look at the same example using the problems that using the common problem that we've been working with so far. And because this level is going to introduce, or because this rule introduces different accounting measures in order to establish the rule, it won't look the same. In other words, we here are using average net income and average book value, and for all the other rules we were using cash flows or cash flows from assets. And so here we're going to establish a different rule. We'll say we'll take the project if it's greater than, say, 25%. Again, we reject the project, and as I talk about in the example, that's sort of intended. But we reject this project based on the AAR. And if we look at our 4 criteria, we see that the AAR fails on all 4 counts. doesn't account for the time value of money. We're using the future values of net incomes to get the average. We're using the future values of average book value to get the average. There's no estimation of risk here because we're not talking about risk. We don't assign a required rate of return for projects at this risk level. And again, we're using future values anyway, so we wouldn't have used it. It doesn't tell us particularly what the indication of value is, although it does give us some measure of the accounting value created in terms of net income. And we don't consider it our primary decision rule because it doesn't really provide much use outside of some specific cases. It is easy to calculate, and the information that we need is usually available because this is accounting information and we're almost always going to have that accounting information. So one of the ways that we might use this is if we don't feel comfortable with our estimates of the operating information that we require to calculate cash flows from assets. So we may not be sure about how the firm's operations are looking, or we may not be comfortable with our assumptions about the future and that factor. But if we are comfortable with the accounting information that's available, then we can use the AAR as a stopgap.